Hi, good afternoon, everybody. I've been given the go ahead to start. So today's topic is another interesting topic, but as a part of Milestones to Wealth, we have spoken at least 3 or 4 times about gold in the last 1 year. Uh, about how as an asset class, gold should have a high weight in terms of your asset allocation, and how gold, be it gold or be it silver, both precious metals together as a basket, should be considered very seriously as a part of your asset allocation strategy. Right. So today, again, going forward with the same thing about how gold should be a part of your asset allocation. I've also covered a little bit about silver and gold mining, so that will be helpful to you. Right. But Milestones to Wealth, as a disclaimer, is not a platform that gives you buy and hold or sell recommendations. It is a platform that is meant to improve your behavior as a saver in India, which means that as you get onto the program, we will help you create a savings habit, which will in turn lead you to create an investing habit through which you can start saving by yourself, or you can choose us to help you in your wealth creation journey. But ideally, it's a behavior oriented platform that will help you get better as a saver in India, help you get better as an investor in India. Right? It's not a buy and hold or a buy sell recommendation platform like your other brokers that are there. It's a behavior program. Right? So treat this as a program, and this webinar is purely meant to help you understand how gold can be a part of your asset allocation strategy. Right? Any questions regarding the asset class, any questions regarding the metal, or any other topic, be it equity and debt, you can please feel free to put it in the chat box once the webinar is done. Right? So why do we allocate to gold at all? Right? This is a question that we keep getting from all investors saying equity is giving us more than 15% return. So why do I need to go towards gold at all? And if you read anything about gold online, if you just Google gold, why to invest in gold, why not to invest in gold, you will get various reasons like gold doesn't give you any dividend. There is no point of doing gold. There's no cash flows involved. It is only meant as an inflation hedge. Yes, it is meant as an inflation hedge. So when you think of inflation, you only need to think of currency, right? What is there in your pocket, and the value of that particular paper is all that you have to think of. So today, if you look at dollar, or if you just see INR, 10 years back, INR was somewhere around 35, 40. Today it is 80. And dollar compared to all the other currencies has again strengthened, but we saw 2 years of weakening, right? So when we look at gold, you only need to compare it towards a currency. And a currency's job is to protect you against any increase in price, which means maintain its value so that what your purchasing power is stays, which means you don't get affected by any increase in price at all, right? Uh, the value of what you hold in your pocket stays intact. It grows in line with, or rather more than the cost of goods going up, right? Which means it makes it easier for you to keep on purchasing and keep on saving, keep on investing so that you can meet your goals a little bit more faster, right? So let's look at what's happened on the gold side. So if you look at gold from a 13-year, 14-year horizon, and this is a very big chart, all this is public data. This is live mints chart that they published at the end of the year. So if you look at gold, gold has had stellar returns since 2018. They've come out on the top since 2018. Right. So from a CAGR perspective alone, in the last 5 years, the CAGR has been somewhere around 14%, which is on par with your equity. So a riskless or a deemed riskless asset class is giving you more returns than an asset class which is extremely risky, right? So you are taking more risk on equity because yes, it's definitely volatile. There's a lot of ups and downs that you keep seeing on equity, but here at the end of that entire up down journey that you have, you still make somewhere around 12 to 15% return by taking on so much risk, which means if a riskless asset class is generating more or less the same return, then you should be compensated more on something where there is a higher risk component, right? But you're not, right? Naturally, you have to look at other avenues where you're able to take less risk, which means the scope of you losing money is lower. At the same time, you are well protected when something bad happens. Right. So if you look at how the cycle for gold has been, gold has had only 3 bad years between 2013, 14, and 15. Right. Apart from that, there has not been a very, very bad year that has come in. 2021 was one more year in which gold was bad, but it was coming off from a high base. So we had 3 good years and then 1 bad year. But more or less, it means that it remained the same. It did not appreciate much. Right. But when did it lose value? It lost value in 2013, 2014, and 2015. Right. Now you compare this to something of a equity oriented asset class and a particular category. Say, let's say small and mid caps, right? Small and mid caps have been on a tear for the last 3 years. And you're seeing stellar returns coming in. So if you look at 2020, 2021, 2023. So you look at 2022, again, you had a very bad year. But in that particular year, gold has outperformed all these asset classes by a big margin, right? It's almost 10, 11% outperformance, right? So you have periods in which it underperforms and you have periods in which it outperforms. And if you look at that particular category within equity, which is small and mid caps, it's very volatile, right? You look at 2011, 2012, 2013, and 2014. One year is bad, the next year is very good. Then again, the next year is very bad, and then again we've had a 1 good year. So investors cannot uh, weather through such volatility without seeing such drawdowns, without taking that much of risk, right? Again, if you look at debt, right, we've had poor returns on debt coming in, and now things are changing on the debt side, right? So debt as an asset class in the last 3 years also has not performed, right? That has not been volatile, but that has been shunned as an asset class altogether. Previously, in 2014, 15, and 16, when things were very bad for other asset classes, right, which is particularly gold, you saw debt do extremely well, right? So every cycle, there's a different winner and there's a different loser, but gold has remained to be one of the largest winners in the last 5 to 6 years. And that is because the macro environment has changed so much, where things around us, things globally have been quite bad. And because of that, people want to look towards another currency which can protect them from any increase that happens in terms of price. And that is why gold has become very, very relevant in terms of asset allocation, and how important it is for you to start adding and continue contributing more towards gold as an asset class. Be it ETF, there are different reasons of why you should do ETF, mutual funds, or SGP, or have physical gold, right? But overall, the reason is the same. And India as a country, we consider gold to be it's more of an emotional asset class, right? We will continuously keep buying gold. These are all ancestral for us, things that we picked up long back, and not this new thing of protecting ourselves towards inflation and all that is for us. It doesn't matter because we've always been buying gold. But as investors, you need to educate yourself as to why, as an asset class, it works in all cycles, given the nature of that particular asset. Right. So now, how do you value an investment like gold? Now, since it is a commodity and every commodity has their own supply issues, and gold as an asset class will never lose out on demand, right? So the only reason of why the price can go up is because of supply. Demand keeps on going up because the utility of that particular asset is very high, which means that we will continuously keep using. The use cases are now going from an investment to a more technological side of things, where they are getting used in our mobile phones, in our laptops. Likewise, even silver is getting used in technology devices. It's coming in data centers. It's coming everywhere, right? Copper again is being used everywhere. So the utility case of commodities is continuously going up. It's improving, which means that the demand is always going to be high. So let's look at the supply, because that's what matters in terms of price. Right. So likewise here, if you see demand has been continuously going up, jewelry demand is going up. As an investment, the demand has been going up. And central bank's demand has been drastically higher in the entire of last year, driven by China. Right. So you're seeing gold today at a high price because China has been very active in the physical market, and they've been buying gold at very high levels. And the premium in China for gold is much higher than what you get in the US. So you can see that people are willing to pay more and more for small quantities of gold in the physical market in China. Right. So central banks have been big drivers of gold that of the price of gold. And when central banks do come to buy, unlike your ETFs or mutual funds, central bank demand is very strong. It's very stable. It doesn't go. No central bank is very wary or volatile, saying today I'll buy, tomorrow I'll go and I'll sell all this gold that's coming up. No, when they decide that yes, they have to scale up on their investments on the gold side, unlike treasury where you can sell and buy, gold is physical, right? You have to store it. So they will not take that risk of taking in and then again storing it and then giving it back. They'll not make any money, right? So this is stable demand. This is long term demand that comes in. Investment for just in case of investment, yeah, you will have a lot of ups and downs, because naturally investors put money into ETFs when things are doing extremely bad, take out when things are looking extremely bad. So investments would continuously keep varying. Right? Jewelry demand is going up, and the use case for technology is again going up. So from this chart, what you can see is demand is growing stably, right? Whereas supply has not grown at all, right? So mine production, which is gold that is being mined out, is very, very low. It has not grown in the last 13 years or so, right? The number has just remained the same, right? But the price of gold has gone up, which means that usually in this case, when the price goes up, right, you will want to supply continuously more and more for you to make, for the mine to make money. But there's nothing to supply at all. It's very difficult for a mine to go dig out gold and then start supplying it to the entire market. So the demand is going up, but the supply has remained very, very stagnant and very stable for the last 13 years. So this presents an opportunity that whatever the mine is able to sell, they are able to sell at a higher price, but the cost also has been going up. So, but still they are able to sell at a higher price, right? So this is what is driving up the price of gold, where the demand has been strong, but supply in the last 13 years has not been there, has not been growing at very fast paces, right? So this is what this is where you're seeing gold today to be somewhere around $2,400 in the US, right? Just in dollar terms, right? So again, if you see here, central banks are rediscovering gold. So central bank purchases have been extremely high. This is slightly dated, but they continue to keep buying. But if you look at one period between 1990 and 2010, they have been continuously selling gold, right? And this has come majorly from the developed nations. And who's buying right now? Buyers right now are coming up more on the developing side. So where is the growth coming in globally from a GDP perspective is only on the developing nation side. So whenever a country that shows a high promise of growth always has to protect some part of their balance sheet, and they will continuously keep buying gold. So developing nations have been continuously buying gold to protect themselves against volatility on the global side, against dollar as a currency, and third, with whatever growth that has to come in, they have to support that because cost is continuously going up, right? You're seeing inflation numbers coming in. So to protect themselves, they have to hedge themselves against all these cases, and that's why you're seeing developing nations leading the pack now in buying gold as a physical asset. So why should you not buy? How does inflation impact gold? Now, if you look at returns coming in, because so much of inflation story has happened, if you look at the US, right? Whenever you've had somewhere around uh, uh, your US CPI to be below, let's say, somewhere around 0 to 2%, you're seeing nominal growth coming in for gold, that is inflation adjusted, to be somewhere around 8.2 to 8.3%. Right? Where it is 2 to 4, again, it's slightly lower because then your yields become much more attractive. But as it stays higher, which is where it is right now, around 4 to 6, purely on the US side, you make somewhere around 10%. So when the price appreciates 10% in the US market, naturally it rebalances in all the other markets, right? So today YTD, which is from Jan up until yesterday, gold price in the US has gone up by 10%. Naturally, in India also, the same has happened, where gold price has gone up somewhere around 9% in the entire of the year, right? But since we hedge it towards inflation, and since the entire conversation in India and in the world for gold has been more towards inflation side, we are in a sweet spot right now, where when we have inflation of 4 and 6%, you will see high growth coming in on the gold side as an asset class, right? Because you don't make money much on debt, you don't make money much on equity. So naturally, you have to look at other asset classes. And gold is that particular asset class that can deliver in all markets going forward. Right. So what do you think was gold's performance versus other currencies in the entire of last? So where do you think gold stands? This is a good poll. Is it 3 to 5%? Is it 5 to 8%? Is it 8 to 11%? Is it 11 to 15%? I already gave you about India for the entire of last year. But what do you think it is in terms of other assets, in terms of other currencies? Okay, good replies. There's B, there's A, there's 5 and 8, 3 and 5. Okay. Okay, so we have two replies, 5 and 8, 3 and 5. Right. Now you look at this number, right? On an average, gold performance in other currencies has been somewhere around 8.5%. So 5 and 8, okay, you were close. So I give it to you 5 and 8% was good. But if you look at Japan, it's 10%. Japan continues to depreciate as a currency. Naturally, gold prices there are skyrocketing. If you look at INR, INR has been very strong, though our currency has been strong in the entire of last year. But gold price has rebalanced, has got rebased, and it was somewhere around 11% last year. Right, so 11-12% is what was in INR last year. But if you look at other currencies also, it's somewhere around 8 or 9%. Right. So you are already seeing gold do extremely well, which means that yes, macro scenario across the world has been deteriorating. The inherent strength in currency has been deteriorating, and naturally you have to compare gold to another currency, and that is very evident from the data that's given here. Now let's look at silver. Now we get this question of, should I go invest in gold? Should I go invest in silver? What should I keep? What should I do? Which one do I sit and choose? It's not silver versus gold. It is silver and gold. Both the asset classes work together. Correlation between both the asset classes, if you see, obviously silver has a higher, is more volatile than gold. But from a precious metals basket side, correlation between commodities and equity given macro scenario has always been that yes, it there's a negative correlation, but this cycle we've seen positive, right? Both have moved at the same level at the same time, but usually it is the case. It's not silver or versus gold. It is silver and gold. So you have to look at it as a basket. You always need to look at it together, right? Now, if you look at silver, there is a huge gap in the silver market. The demand has overshot, has clearly overshot. We last saw this between 2010 2013, but clearly demand for silver has drastically gone up than supply. Silver as a metal does not. There is no mine. There is no area that people just go purely to mine silver. Silver comes along with gold. Silver comes along with this particular metal. It comes as a gold equivalent. So there's no way for you to even mine that particular say commodity, but it has been that's why it has been very volatile. Reporting standards have not been that adequate. Naturally, you don't know what the scenario is, so it is very volatile. But demand has clearly overshot supply. It's the same case for gold, but here the demand has completely overshot supply. So we are in a drastic uh, uh, scenario where that's why you saw one good year in silver, and this was during this phase where there's no supply coming in for silver, right? Where we were in the net supply area, now we are completely against. So there's no supply that is there for silver. So the demand is naturally higher. So the price naturally is higher. Right. So what do you think was silver's performance in other currencies? Let's look at silver. What do you think has been silver's performance in other currencies? B again. Okay. 5 and 8. C. Okay. 8 and 11. Okay, so let's look at the number. This number is very volatile. If you look at the performance that is there on the silver side, silver is very volatile. In some countries, it is 8%, in some countries, it's 5%, in some countries, it is 9%. But on average, it is somewhere around 6.5%. But if you look at the reds here, there are too many reds here. 2013, 14, 15, you see too many reds. 18, too many reds. There are too many reds here because supply is very low. It's very what it's not traded much as a commodity. Liquidity is very low. Naturally, it's very, very volatile. If you compare this to gold, let me just go back to gold. If you look at gold, gold doesn't have much of reds. It is well traded. That's why you see here on the gold side, we would always prefer to take gold because it is less trade, because it is readily available. It's very, very liquid, right? There's enough data coming up on the gold side. So there's a good amount of comfort in terms of risk that we can take on the gold side. But for silver, you need to be very precise in terms of the risk that you're taking in this particular asset. If you see it's very volatile. There are too many rates that is coming up. So when you want to weather through such volatility for silver, always try to look to get it at very low prices. Otherwise, it does not work for you. In INR alone, last year it did not do well, but CAGR has been somewhere around 11%. 9%. For gold, it was somewhere around 11%. So when you're able to make such returns on a risk-free asset class like gold, silver definitely does not look like it's risk-free. There's a lot of it's very, very volatile. Naturally, you have to consider this very seriously when it comes to you saving in a particular asset class, right? Equity, debt, and gold needs to be looked at separately. You cannot look at it saying equity performance should come on debt side and gold side. Gold performance should come on equity side. I should be able to make more returns by taking less risk. No, every category works different, and gold as a category works in this particular manner. Silver as a category works in this particular manner, right? So again, where does all the gold come from? We saw that supply is very low. Where does it come from? Does it come from South Africa? Does it come from US? Does it come from China? Does it come from Russia? Where does the gold come from? Okay, South Africa. Okay. Okay. I really appreciate this. No idea. I did not put that option in, but I really appreciate honesty. No idea. That's why when the next slide comes, you'll get a fair idea of where it's actually coming from. Okay. A lot of you have said South Africa. Where does it come from? South Africa used to be a big chunk of gold, but now it's spread across. It comes from China, it comes from Russia, it comes from Australia, it comes from Canada, and it comes from the US, right? But China overtook South Africa as the world's largest gold producing country. But most of the gold that's there in China is inaccessible. They have a lot of gold, but they buy out mine everywhere. But some of you were right. There was a period in which South Africa accounted for the largest source for gold. In 1990, they were producing about 1,000 tons of gold, right, which was 50%. Right, at that point of time, it was clearly 50%. Rest of the world, which is inaccessible, we don't know where it is. It's about 1,000 tons. So totally, there's about 3,000 tons, out of which one third used to come from South Africa, and then one third comes from the rest of the world. Everything else is split across Russia, China, Australia, Canada, and the US. Right, but most of the gold mines are listed majorly in US and are listed in Canada. Right, so let's look at the mines now. Where does it come from? So the gold mining industry's market cap, this is last year's data, is significantly lower, and obviously is going to be lower because they've not performed well. Prices for operating those mines have gone up, and gold has just started to go up in this year. Last year, there was not that big of a performance that came in, but at that particular price also of $2,100, costs were up, so they were not able to make enough money on it. But if you compare it to the entire energy sector, it's still very small. It's 1/5. If you compare it to diversified mining industry, it's still low. It's about 1/4. And if you compare it to technology, naturally, it's nothing compared to technology, right? Because a lot of money has been flowing onto technology as a sector. Other mining industries, commodities where it's very difficult to replicate those businesses. There, the value of these businesses are very, very low, right? So there's a significant opportunity for investors to take advantage of here, right? So if you look at the life cycle of a mine, it takes a long time for you to go from I'll start digging, I'll start searching for it and getting approvals and making sure that the gold that you're able to mine out of is now being sold in the current market and you're being paid for it, majorly being paid for it. Right? It takes 7 to 8 years for it to go from discovery, feasibility study, and then to commercialization. It's 7 years is a long period, which means not a lot of people can actually commit money to such projects because they are extremely high risk projects. They're extremely high risk projects, so they can't even go out and start taking debt. But what about cases in which in the particular cycle where they were leveraging up, where they were taking on that debt? One, it's difficult for somebody to stay invested for 7 8 years in equity itself in India, right? But here people are committing money to mines in which you don't even know what is there below. Right. Already investors in India cannot stay for more than 3 years. They want a doubler that's coming in within the next 1 year, 2 years. They want a 4x, 5x, or a 10x that is coming in within 1 year. And expectations are so high right now. Right. So how is it that people are willing to commit for 7 8 years for a particular mine that we don't even know whether they will get the required approvals for them to go start digging in deeper, discover it, and then ultimately lead into commercialization. Right. So it's a very expensive project. Right. But in this particular cycle, they've had the highest levels of cash in history. Why? Because gold price went up. What they were keeping as inventory, they were able to make a really big money off of. But the last time we saw this scenario was in 2010. And from there on, if you see, there's a one-way drop. There's a one-way drop in terms of cash levels. And why did that one-way drop take place? Right. Today's scenario says that they are flux with cash, but why did that one-way down actually take place? Right. Here, if you see the average discovery cost, like I said, the costs of operating mines has been continuously going up. Right. And these are average size mines. So the largest mine has a capacity of 6 million ounce. So half of that is about 2.5, 3. So if you see, the discovery costs have continuously been going up, right? So like I said, if you want to commit for that 7 years, one, you have to pay too much. It's a very expensive project. And second, if the metal price that you're ultimately selling does not go up, then you, as an operating mine, continuously you will die, right? You will not be able to survive the market, and that's what happened, where they were not able to survive, right? Because they had too much debt. The funding was very large at that point in time. But from 2016 all the way up until 2023, they've only been selling off that debt. Right. So for somebody to supply that particular metal, the people supplying need to be in a very good shape. And only then they will have enough demand coming. So to meet that demand, naturally you have to keep on supplying. And now they are sort of meeting that demand very slowly. It's still about 6 million, 7 million ounces that the largest player can do. But the entire sector went through a deleveraging period between 2015. This is when the price of gold was going down, right? So I asked you this question: what happens when, yes, you are getting funding, but the metal price starts going down, and you are flux with cash? What happens then? What do you do then? So to survive, naturally they had to go to a period of deleveraging. And today's scenario says that they are flux with cash. They don't have much debt on their balance sheet, and that's why you're seeing the price of gold today is where it is. That has also it's a handshake, so that has also made them survive, live, at the same time make enough shareholder returns. Right. So they did not spend money at all. This is silver. This is silver. They did not spend money at all in terms of silver mining. Naturally, today the scenario is such that gold mining as an industry looks very, very attractive in terms of valuation. So the price of gold has gone up. Costs have come down. Costs are remaining very high, but their balance sheets are in very good shape right now, and they are flux with cash. So this is what investors need to look at when it comes to looking at gold as an asset class. When you look at how it works towards other currencies, silver, yes, it's very volatile, but it goes hand in hand with gold. Naturally, in a scenario where precious metals are doing well, this metal also will do well. And second, so third, which is further down the value chain, where there is extreme risk that comes in. Where is it that you can start taking risk? This is one area where, yes, if you're looking for taking on risk, this is one place that you can look at when you want to take that particular risk. But I would say that a majority of investors should only look towards gold and silver, and only look at mining if you have the risk appetite, if you have the risk. I mean, if you have a high risk profile. Other than that, gold as an asset class should be at least 5 to 10% of your portfolio. That's what gold is. Now I'll open the floor for Q&A. I've also put the number here. So if you have any other question regarding any other particular asset class, uh, please feel free to get in touch. If you have a query in terms of how you have been running your entire portfolio, please feel free to get in touch with us. Any other doubt, again, just send us a hi with your particular query. Somebody from the team will get in touch with you. We have a question saying, why is China buying gold? China is in a mess. If you look at, they're moving from old economy to new economy. Usually when this case happens, you see, usually there's a stimulus that takes place, right? We are so hell bent on getting stimulus everywhere. They are not giving any stimulus to real estate. They are giving stimulus outside, and this fear is there amongst everybody right now that we are pegging ourselves to the dollar. And if the country which is high risk right now to recession, their inflation is very high. They are at high risk for recession. So do we need to hold that particular currency on our books? And it's a risky bet. So naturally, they would look to diversify, and that is why they are looking towards other asset classes. That's why they're looking at an alternate currency. What is the gross total production of gold globally and consumption in tons? See, there is about 3,000 odd tons, and so 2,000 odd is what is available to us, and only that keeps on going. I mean, some is above, some is below, and below, if you see somewhere getting supplied around 2,000, tons, everything else is above. India doesn't produce gold. India is only a buyer of. India is somewhere around 700, 750 tons. They will buy this every year. So it has to be 7.5% of their central bank reserve. So we can help you out in purchasing SGB straight away. You don't have to do this on your own also. But just send us a hi and we will be able to help you out to get gold SGB for you. Is SGB connected to a gold reserve? Yeah. So it's a paper that you own that particular gold, but you're giving it to RBI, and RBI is giving you interest on it. So yeah, it is connected to a reserve. And SGB also, we've had high subscriptions for SGB. So it's not 700 tons, but everything is included in the 700, 800 tons. So yes, it is connected. SGB, if you are interested in buying the SGB, just send us a hi on this message, and we'll be able to help you out in terms of getting you the paper. I'll keep the floor open for another 5 minutes. Anybody who has a question regarding equity, debt, anything, you can please feel free to put it on the chat box. No problem at all. Thank you for joining in. Next time, it's not only limited to you. Please get in your family members. Please get in your friends. Our entire endeavor of Milestones to Wealth is a behavior program and to help a lot more investors to get better as a saver, get better as an investor in India, so that they can have a very comfortable wealth creation journey here for a very long period of time. Right? Please do bring in a lot more people from your side as well. We are anyways putting out content. We are sending out invites. We are sending out from our side. Everything is coming from the central number. But I do understand that a lot of you have come in. A lot of you have supported us. You've come spent an hour of your day every time on a Sunday. Sometimes we have 2, 3 webinars, and I really appreciate all your support and thank you so much for it. But please do bring in a lot more people from your end, and because it will help them. We are expanding very fast. So please do bring in a lot more people from your side as well. Expected CAGR of gold. See, in the last 5 years, it has been very high. You can expect somewhere around 9 and 12%. No. If the government changes, is there a chance for new gun? No. Nothing like that. It's the RBI thing. It's not the government thing. And this has been there since 11 and 12. Only now it has, in the last 3 years, people have become aware of it. You've been made aware of it. But definitely, SGB is not going away. So it's been there for a long time, anyways. I'm a PMS investor. I like your post. Thank you so much, sir, for your support. If there are any further questions, I'm very happy to take it. If not, I think we can close. Thank you so much for joining in on a Saturday afternoon, taking out your time. Have a great weekend ahead. I'll see you again next week. Thank you so much.